Hello, everyone. Welcome to the fifth session of our 2020 GC3 Virtual Roundtable. My name is Michelle Jalbert, and I am the Chief Operating Officer of the GC3. The GC3's membership spans more than 125 companies across the entire value chain, all working together to accelerate the commercialization and adoption of green chemistry. We engage with members in a variety of projects and programs and encourage you to reach out if you are not yet a member. So thank you for joining us today to learn more about what we do. We're very grateful to our host sponsor, BASF, for their support of this 6-week event. They have been a wonderful partner in putting together this virtual roundtable. We also appreciate the support of the sponsors of this week's commercialization theme: Dow, Johnson & Johnson, Lego Systems, Lowe's, and RB. Today's discussion will delve into the emerging trends in the finance community that affect the adoption of more sustainable practices. This session will explore the increasing push toward environmental, social, and governance investing and the potential impact of these trends in accelerating the adoption and commercialization of green chemistry ingredients and products. You received their full bios yesterday, so let me quickly share names, titles, and affiliations of everyone participating in today's session. Our panelists include Susan Baker, Director of Shareholder Advocacy, Trillium Asset Management; Wilma Brown-West, Director of Consumer Health for EDF Plus Business; Julia Gorte, Senior Vice President for Sustainable Investing, Impacts Asset Management; Alexandra McPherson, Consulting Program Manager of the Investor Environmental Health Network. Jim Jones, a Strategic Advisor for the GC3, will moderate the discussion this morning. Jim? Jim, you need to turn your mic on.
Thank you, Michelle.
You're welcome.
Thank you. And thanks again to everybody who's joining us today for this interesting session, and a special thank you to our panelists for taking time out of their busy days to help educate and inform all of us. You know, as everyone who's participating in this webinar knows, that the mission of the GC3 is to drive the commercial adoption of green chemistry by catalyzing and guiding action across all industry sectors and supply chain. That is our mission. And at GC3 and historically at the Roundtable event, we have often focused on the role the retailers play, the role the consumers play, the role NGOs play, the role that government can play. We have not historically spent much time talking about the role that the investment community can and is playing as a catalyst towards action towards green chemistry. So I'm hoping that after today, you'll have a deeper appreciation of the role that the investment community is playing in this very important space. And we as a community can figure out how we can be more involved in helping them to help us to catalyze a greater investment in green chemistry. So with that, and our first panelist this morning is going to be Julie Gort from Impacts Asset Management. So I am going to turn the floor over to Julie.
Good morning. I'm Julie Gordy from Impacts Asset Management, and as I was just saying to my fellow panelists, my responsibility is to connect various aspects of sustainability to financial outcomes. And you'll probably, it's not a mystery novel. Most of the time, the academic and financial studies that have a methodology you can actually review, or that have been peer reviewed, show that there is no sacrifice of performance when you incorporate sustainability into investment management. It just gives you more information to make an investment decision on, and oftentimes that decision is a good one from the standpoint of portfolio performance. I also do a certain amount of public policy and company advocacy or engagement in my position at Impacts. And one of the things I'm going to be doing very soon with Allie McPherson, who's also on the screen right now, is an engagement on chemical companies and their use of substances that in facilities that are in primarily minority communities and the health impacts of those. So it's an environmental justice thing.
Thank you, Julie. And next, Susan Baker from Trillium Asset Management is going to talk about what her role is and what her company does.
Thank you, Jim. A pleasure to be here. As Jim mentioned, I'm a director of shareholder advocacy at Trillium Asset Management. We manage about $3.5 billion of invested assets for individuals and institutions. All of our funds are truly analyzed and managed with an impact-driven and ESG-focused mandate. Responsible, sustainable investing. You'll hear on this call many different terms that are used for ESG. So we've been around since 1982. As Julie rightfully mentioned, there's no need to sacrifice financial return from integrating ESG performance into the investment decision-making process. We've long believed that. In fact, our founder, Joan Bavaria, really set out to prove that when she started our firm. She came out of a traditional banking background, and that's been really the heart and soul of what she wanted to do and what we continue to try to do today. So we have a ESG integration process, a fundamental research process, and an active ownership process, and that's where I come in. And chemical safety and chemical management has been a priority area of mine for the last several years. We were one of the early members of the Investor Environmental Health Network that Ali now leads, as well as Ceres, which I notice is a resource organization for this group. We've partnered with them many times on our advocacy work, as well as with the Interfaith Center on Corporate Responsibility, another multi-stakeholder group of faith-based and socially responsible investors. So there's quite a critical mass of investors that are really looking at these issues and incorporating them in their investment analysis. And throughout this webinar, I hope to share some of those examples and just how it can really impact and align sustainable investing going forward.
Thanks, Susan. And Ali McPherson from Niagara Share and Investor Environmental Health Network. Ali.
Thanks, Jim, and thanks to the GC3 for inviting me. I manage the Investor Environmental Health Network for Clean Production Action, and I'm really thrilled to be on this panel with two of our pioneering members, Trillium and Impacts. I was thinking Clean Production Action, CPA, turns 20 years old next year, and there's some interesting trends that emerged that I think are really relevant to our conversation today. I would say for the first 10 years of CPA's existence, while we were intended to be the solution-oriented organization, we really focused a lot on the problem and making the case that it was a business and consumer risk and sort of a problem that we needed to address. We measured toxic chemical concentrations in household dust from vacuums, breast milk, consumer products. Our investor partners that have been with us for a long time, they filed countless resolutions addressing the financial risks of toxic chemicals. But then I would say about 10 years ago, really a big shift started to happen. Companies started, we just spent less time on the problem, more time on the solutions. Companies started asking, what is a safer chemical? How do we avoid regrettable substitution? Investors started to say, how do we more systemically measure this problem? What is the value of green chemistry to investors? And also just there was a lot of leaning into the United Nations Sustainable Development Goals, which I hope we talk about more today, particularly SDG 3, good health and well-being, and 12, sustainable production and responsible consumption. So fast track to where we are today, I think have the opportunity to talk about some of the major standards like SASB, where material risk is really being assessed by investors, and the chemical footprint project that Clean Production Action created and that we work on closely with all of our IAHN members. We engage between sort of 40 and 50 companies every year to address chemical management programs, adopt best practice, reduce risk, increase value. And we're seeing really positive trends within the marketplace, towards safer chemicals. So I'm really excited to be here, Jim, and have this discussion.
Great. Thanks so much, everyone. And our fourth panelist is having some difficulty getting onto the platform, but we'll start with asking some questions, and then if Boma is able to join, we will let Boma make some opening remarks as well, and then she can jump right in. So, Ali, I'm gonna come go right to you with actually just hoping you can give us a little more granularity on SASB, which some of our members may be familiar with SASB, but I'm not sure it's a system that everyone who's on this webinar has got any just even basic understanding of. So you could give a little bit of a primer about SASB, which seems like it might be a really useful tool in this space.
Yeah, sure. And still, fairly new. I think we're 3 to 4 years into it. But so SASB is the Sustainable Accounting Standards Board, and it's supported by 4 of the largest investors, Fidelity, State Street, BlackRock, and Vanguard, among many other investors, but just got a huge amount of, I'd say, investor support around it. There's 77 different business sector standards, so each one is tailored towards a specific materiality risk within each of those standards. I wanted to just, touch on the chemical standard because I know Julie mentioned some of the work we're doing and engaging companies around some of the risks there. There's a comprehensive set of indicators on chemical management. I think one of the ones that's most interesting to discuss today is where they really look at product revenue contingent on chemicals of high concern. And so this really gives like a baseline for a chemical footprint that investors can come back to and measure every year on how companies are really reporting on sort of their progress towards reducing this risk. And it comes back to this major issue of environmental justice. Most of these chemicals are some of the most toxic and egregious chemicals. They've already been sort of established as a known risk. And those on the front line or in the workplace, often face a disproportionate sort of impact from those chemicals. Ecolab and CF Industries were the only 2 companies that I saw really reporting to this risk. So I think there's a lot of opportunity for more disclosure across the chemical industry, and Ecolab is a participant in the Chemical Footprint Project as well. And so we see those companies that are disclosing these footprints as real leaders, and they're really, I think, preparing to be sort of on the cutting edge and able to answer more of these disclosure metrics that investors are using to, base whether or not they make these investments. Retail is also a huge sector where there's, I think, over a dozen product safety chemical risk indicators. So it just gives you a sense of the scale of performance metrics that investors are now measuring. And I would say this sets the standard, and the Chemical Footprint Project really, for us, is a way for companies to organize data that then goes into these specific metrics that investors have set for themselves, and then they weigh, according to their different priorities as an investor, the different value across them. But it's a really, I think, a unifying standard for us to look towards sort of our North Star and disclosure and reporting.
Thanks, that's really helpful. So I want to sort of build out on this issue of information and disclosure. Maybe I can ask first Julie and then Susan that this is not my field, investment world, but sort of just a casual observation. It looks like in the environmental, social, and governance space, ESG, that climate tends to be the environmental concern that is most often evaluated by investment houses. A, is that correct or incorrect? And then B, is that for chemical safety, which for us is a very important part of ESG, and the GC3, what is the role of information and the challenges associated with information in the chemical space? Does that play in the relatively low priority chemical safety seems to get broadly, obviously not by your 2 firms which focus on it. So if you could start with you, Julie, comment on first that overall sort of the relative priority climate or chemicals get in the ESG analysis, and what are the factors around that? So you're muted, Julie.
I could just speak
I'll
in
let Mike
some
an
language
example.
if you'd rather. Sorry about that. I always swore I wouldn't be that person, but you know, I am. That's my first mistake ever. Okay, one of the reasons that we always consider climate is because every company and every investor faces some kind of climate risk. We used to think it was mostly a risk for the high emitters, but now that we're sort of staring physical risk down the gullet, like this year with all the hurricanes and over $16 billion weather events and fires, we're really looking at physical risk vulnerability being basically everywhere. They're just different risks. Chemical risk is much more sector and industry specific. And while it is, but where it is a significant risk, it's considered in most funds that really integrate ESG and don't get by with just a few automatic exclusions, which neither we nor Trillium do. Use and disposition of chemicals used in producing or embodied in products come up in many industries, not just the chemical industry. It comes up for most of the industries are in the energy sector, the materials sector, food and beverages, healthcare, pharma, renewables, infrastructure, household goods, beauty and hygiene products, toys, electronics manufacture, and transportation, and obviously in retail, which you'll hear more about, I think, later from Suzanne. The weights differ in different industries and sub-industries, depending on what the menu of material issues is for that specific company and sub-industry. There are things that make it hard to analyze and things that make it easier to analyze. On the easy side of the ledger, there's a lot of quantitative information about the use, treatment, disposal, and recycling of different chemicals in EPA's various databases, including both ECHO and EnviroFacts. They're always out of date, but that's just because of the way the data are collected and then displayed. But they're only, some years they're only 2 years out of date, and so they're still pretty useful. For other countries, environmental regulatory databases often exist as well. Not all of them, but you can always get that for the EU and for a lot of other countries, including places like Mexico. So it's not just developed countries. We also rely on company disclosures, and we all use various techniques to discern whether we're being enlightened or greenwashed when we do that. One of the primary tips is if a company is disclosing its challenges as well as its successes, we are much more likely to believe what it says about its successes than if it sort of portrays itself as perfect, because I've never met one. But the disclosures that companies make are almost always voluntary. So that information is very incomplete and in many cases not comparable between companies. And in the investment world, those are two characteristics of perfection. You have the same data for every company in the peer group. On the difficult side, there's a whole lot of chemicals used in goods we consume, either in production or the product or both, that have not been thoroughly tested for acute and chronic effects, and about which we do not have good information about exposure pathways. Knowing that a company uses a specific chemical of concern or produces one is like knowing a company's greenhouse gas emissions. It's good as a start, but in order to make an investment decision, you also need to have information about the rest of the impact chain. Are all the emissions reported? Has the company established a target for reduction? If so, is it a science-based target? Do you intend to hit net zero by 2050? So what the company is doing to manage chemical risks throughout the possibility of harm chain that is the most investment relevant information we can get, and often we can't. Thanks.
Thank you. Susan, if you were to design the sort of ideal information tool to make your job evaluating chemical risks easier, A, does it exist already? That would be great to know. B, sort of broadly, what would it look like?
Yeah, right now it takes a lot of work. 20 years ago, we didn't have any KPIs around this, and it is getting a little better. And what we're finding is that at this point in time, we have to draw from many different resources. Outside data service providers such as MSCI have a chemical safety pillar. They look at exposure risk. Is the company exposed through their products and supply chain to chemicals of high concern? are they geographically exposed to countries or municipalities where there are chemical restrictions in place. So we look at some of those data points that are coming from outside services. We look at company reports. Creating the best framework, I mean, we really have to look at the risks and push them against the opportunities. So that's why we are an early signatory to the Chemical Footprint Project, because that is one that's trying to quantify risk and moving away from those chemicals of highest concern and then shifting toward solutions. We're really about positive solution-oriented investing. So I think that would be the most ideal framework if we could find those companies. And you know, a couple of examples that we are currently invested in our ESG Global Fund is a company called Croda, a European chemical company that's moving away from fossil fuel feedstocks to biofeedstocks, and how they're doing that through innovation and really pushing the industry towards this more sustainable supply chain practice.
So it sounds like it's safe to say that it's when you're looking at a company from an investment perspective, it is easier for you to evaluate their chemical safety score, let's use that word, if they're a chemical footprint project than a company that's not, or is that an exaggeration? Or
well, at this point, I mean, the Chemical Footprint Project, we have about 30 companies that are responding. We don't have all 30 companies disclosing their results. I mean, that's a big push this year, is to understand why companies are reticent to provide more disclosures. Yes, a chemical safety, I mean, one of the problems that we've seen over the years is it's a backward. We hear about controversies and safety after an event happens. So we need to like move beyond that and find how companies are developing positive ingredient lists and developing those industry solutions, as opposed to just marking this incident happened. Is it going to happen again?
thanks. And Allie, maybe you could just, I know GC3 at various roundtables, we have spent time on the Chemical Footprint Project, but maybe you could give our participants just a thumbnail sketch so they're sort of grounded in the conversation related to that effort.
Sure. Yeah, so I mean, the Chemical Footprint Project is really modeled on the Carbon Disclosure Project. So, you know, we saw the value of that consistent standard and set of benchmarks and metrics, qualitative and quantitative, that investors could use on the carbon side. And we wanted to see, can we create it on the chemical side? Because as Susan said, it didn't exist. And so it's really like two parts. One is the chemical footprint survey. So that's 19 different benchmarks, and we consider those, they're questions, but they're really best practice. And so companies like Walmart and Becton Dickinson and others, but it's still, you know, a small handful of leaders participate annually in the survey. They get assessed against these benchmarks. Some of them in the last year have disclosed their actual score and sort of the questions, which was a great step forward in terms of disclosure, particularly having Walmart do that sets a standard for the retailers. But it's a 100-point survey, and you get a score every year. The other piece that's really unique is the actual footprint metric itself. So the survey is 4 pillars: management. It looks at management approaches. It looks at how companies inventory their chemicals. Do they have a full inventory? Do they understand all the chemicals they're using? The footprint metric, which I'll explain in a second, which is unique. And then the disclosure piece, which is, I'd say, where we have the greatest room for improvement amongst the participants. But the footprint metric itself is what you could really use to assess a company's risk, I would say, because it sets up a parameter of 2,200 chemicals that, you know, are aggregated from the green screen list translator, which organizes a bunch of lists of chemicals that are disaggregated in the marketplace. These are chemicals that are known to cause harm to human health and the environment. These are known to cause risk. So they're either being potentially regulated in Europe or certain states. They're consumer concern. These are the ones that are going to really rise to the top quickly as a sort of a chemical risk factor. And so for companies, to not know these chemicals are in there, that they're dependent on these chemicals for their operations or their product or their supply chain, because the chemical footprint covers all those categories. I think it's, really problematic for investors, again, then they get caught off guard when there's, a public crisis, around multi-concern. And so the whole idea is to avoid that and disclose it, but also just to really reward companies adopting best practice, participating in this, disclosing what they're doing well and what they're not doing well. That's, where we see, leadership and, really a change happening in the marketplace right now.
Thanks, that's helpful. I just want to let our viewers know that if they want to post questions, there's a little question box, and you can ask a question, and they'll come to me, and I'll read them as they come in. But before we sort of move on, and I see it as somewhat of related to this information issue that we've been talking about in terms of making informed choices in investment, I'm confident it's not exclusively about information. I think there are a lot of other factors involved, but I think there's an interesting segue with this broad area of information as it relates to environmental justice. There's often a place-based element to environmental justice that isn't available with this broad aggregating of how many chemicals and how many pounds of a chemical are in products that then get dispersed all around the country or the world. What it would be useful to hear actually from, because I think all of you are thinking about this, and it sounds like two of you are actively working on it. The kind of information you would need to make informed choices as an investor related to the environmental justice, or the potential environmental and justice impacts associated with the potential company you're potentially thinking of buying. What I would guess there is information that's not easily available because of this, but maybe there is, and it's just about tapping into it. And Julie, maybe you could start, and then Allie.
Sure. So there is information that's available. I wouldn't call it easily available. So if you can, for any facility that is regulated by EPA in the United States, find out by plowing through EPA's extensive databases what the demographics are of the surrounding community. And you can define the surrounding community to a certain extent. So for things where the exposure is primarily limited to being inside the fence line or close to the facility, that is a useful data source. Now, that is facility by facility. And as you know, there are companies that have dozens of them, right? So gathering those data, I should say, remembering my Latin, it's not that datum, it's those data, is a very labor-intensive thing to do. If you really want it, you can get it. You can also get a list of all the NPL sites, the national priority list sites of brownfields and Superfund sites, where there could also be, sort of local exposure to things, and a list of all the companies that are tagged as being either owners or partially responsible parties for the pollution that ended up on those sites. So there are data that are available, at least in the United States, on demographics. Now, for pollutants that travel more widely than that, like if it's a groundwater plume, there's a whole lot we don't know about where groundwater goes in the United States. So it's not perfect. There is some available. It's labor intensive to get at, but that's what we have. And so that's what we're going to use.
Allie, if you want to expand at all on that, and if not, I have a specific question related to benchmarking and SASB. But
I would just say, I think right now that it takes an enormous amount of work on behalf of the investor, on behalf of the fence line community, on behalf of the worker to understand the risks. And I think that equation really needs to be flipped. I think the responsibility and onus needs to go on the manufacturer. And I would just give sort of Panasonic a shout out here, because I live by Panasonic in a facility they have here, and they have an amazing process where they assess almost all the chemicals coming in and all the chemicals going out against different human health and environmental criterion and a wide list of chemicals. And so you have a very good sense of the types of chemicals that they're using, and then how they're leaving in the air, water, and products, and hazardous waste. And there's a lot of disclosure. To me, that's the model going forward. And I think once you start accounting for that as a company more broadly, you start managing it and reducing risk. And right now, how we're responding to it is we are just working across cancer clusters up and down industrial corridors now throughout the entire United States. And I live in Buffalo, New York, and we have so many right in our backyard, and they're small compared to those down in New Orleans and Cancer Alley up the Mississippi River. And I just think this is the opportunity for green chemistry where we don't have to deal with these risks, and why, I think we're really excited to, work with the GC3 on how we accelerate these types of chemicals that are safer for communities and workers in industrial, and specifically in industrial communities.
Do you think go ahead, Julie. Yeah.
I'm so sorry. Just wanted to add
okay.
one quick thing to what Ali was just saying. Disclosure is, companies usually hate getting the questionnaires and filling them out in the same way that they hate financial reporting. It's a pain. It requires a lot of data collection, a lot of data keeping, a lot of good systems, and it takes a while. So it's not a cheap or easy thing to do. But what the whole point of investing is to skate to where the puck is going to be, not, as Susan pointed out earlier, once the thing has happened, you can't possibly react fast enough to avoid taking a financial bath if there has been a disaster.
Mm-hmm.
We're not flash boys. You can't, the only way you can foresee things is if you have a lot of information on what has happened and what the policies are to prevent a bad thing from happening. So disclosure gives investors a lot more confidence in making decisions that aren't going to surprise them. Investors are the group of people in the world who are most opposed to getting surprised.
Do you think that there is the need for, maybe there already is one, a SASB standard that would, for those who participate in it, have companies be reporting in a standard way, in a way that made it easier to evaluate their environmental justice footprint?
Sure. But here, so there
isn't one right now.
There is, obviously SASB, but yeah, as far as, as an environmental justice standard reporting protocol, no, there isn't, but it's, as long as it's SASB-like or GRI-like, it's going to be voluntary. The thing that will really solve things for investors is mandatory disclosure. And yes, nobody wants to hear that, but it's true.
Well, that was one of our first questions, is to what extent do you think resistance to disclosure is related to supply chain communications issues concerning safety data or concerns about potential liability? Where does the resistance come from?
So some of it is just the time and effort involved in collecting the statistics properly so that you can report them. I know I've gotten a lot of questionnaires that I've gritted my teeth through. Every RFP I get, explain your investment process, explain everything. It's a pain, but it is also necessary, to give that information out. So that's part of it. Another part of it may be that companies that feel vulnerable or liable or have things that they don't want anybody to know think that not disclosing, may opt not to disclose because they don't want to disclose something bad. But here's the problem with that. If you do disclose where you have challenges or where you have problems, anything you say about what you're doing that's right is more believable, right? Mm-hmm. So if the investor doesn't know anything about you, if you're not disclosing any information that allows them to make a call on where you're going, some of us will opt to say, all right, well, this company doesn't manage these risks, so we're going to assign it a very high risk premium in the buy decision or the sell decision.
Let's pivot a little bit from this information issue, which I think is really profound and challenging and influential in this space, to some of the other factors that investors are looking at. Lay people in this space like myself simplify it into, well, there are two things you'd want to make sure you know about. One is the downside, is that, and that's a little bit of what we were talking about. Does this company have liability related to a chemical concern that's going to create a large liability for them, either because consumers suddenly stop buying products with it in it, or something really, really bad happens and they end up paying money through some other kind of mechanism, whether it's tort or otherwise, versus the we're in a 1995 Amazon moment where we're an investment in green chemistry is actually today is going to give you these huge returns in 20 years, because this is where the consumers are going, it's where the market's going. And it'd be interesting to hear sort of which of those two factors, and maybe it's both, play into sort of how you think about weighing chemical safety in an investment choice. I'd love for it to be the latter, that it's actually, this is an Amazon moment and we all just need to find a green chemistry company out there. And but it'll be interesting to hear actually from all three of you. Maybe Susan, you could start and go around the horn.
Sure. Well, I had a conversation with one of our fund managers before this webinar, and he pointed out to me that the fund that he runs, and he's been running it for 20 years, in fact, it's been the materials sector that's been among the top performing sectors for his fund. And he's been able to find those companies, he believes, by asking some of these questions. And if the data wasn't there, or if the profile was too risky, he just didn't buy the stock. And it was interesting. He gave me the example of DSM, company that's gone through a huge transformation. But in the mid-2000s, it was a company that had three segments: nutrition, materials, polymer, intermediates. And we were impressed with its life cycle analysis and management of its direct impacts, but it was rejected by our investment team because of its chemical and hazardous chemical profile. So it was making, at that time, sodium cyanide, and acrylonitrile, probably not pronouncing that correctly. So we couldn't determine the company's revenues for CMR or PBT chemicals at that time. But 2 years later, DSM divested their polymer intermediate segment, drastically reduced its risk profile, and the company is no longer manufacturing chemicals of concern that we felt would exclude it from that portfolio. So it's kind of an example of a transformation. I mean, actually Target, he gave me as another company which we did not invest in our ESG Global Equity Fund until 2017, because we could not visibly see a commitment to reduce chemicals of concern, while other companies were beginning to do that. So I think the weight, it has to be, there's a lot of work in digging and asking questions and understanding where these companies are going or not going.
Julie, you want to weigh in
Sure,
on that?
Yeah, no, Susan's examples were perfect, actually. I mean, I think one thing to understand, I think we're more in your Amazon moment than anywhere else, but I don't think 20 years is the right time frame. If investors can see that you're doing good things today that are going to pay off in the future, they will price it now. One of the ways we price a stock is by using a thing called the dividend discount model. And what that does is it discounts the future dividends of the company. And if we see a reason to think that the company is going to grow faster or have more dividends, or or avoid liabilities, or avoid having to set aside reserves for litigation or something like that, that will work into its price today. So it's not, you don't wait until the thing actually pays off in order to price that. You say, all right, the company is headed in this direction, that's what we're pricing. Now, if you disappoint them, investors, obviously they'll take you down a couple notches, but that's why knowing what's going to happen, why seeing the plans that companies have for green chemistry and for greener products and for, you know, greater risk management will pay off today. And I have 800 studies in my database that all say that. Not exactly that, but close.
Alex, did you want to add something to?
Yeah, I mean, I would say, you know, you can't ignore the obvious in terms of policy leveling the playing field. You know, we can look across the ocean to the European Union and what they've done with REACH and how transformational that's been, or what they did with the restriction on hazardous substances and how that transformed the electronic sector, not just on the substances that the directive focused on, but more broadly. You now have Apple, who holistically, HP looks at the chemicals of high concern and works to reduce them ahead of regulations. But I would say that's, you know, really critical. And if you look at what the EU just put out on their new chemical strategy for a non-toxic future, zero pollution, it's an incredibly exciting playing field to be in. I think you have states here like New York, where I live, California, Washington, that are doing pretty transformational work and focused on vulnerable product or industry sectors like children's products or, you know, cosmetics. The Safe Cosmetics directive was just passed in California. It bans 24 chemicals. So, you know, the patchwork is not helpful, I think, but it does start to, you know, create momentum for some, you know, transformational changes, particularly, you know, in sectors where there's high exposure. And I think that consumer and personal care and cleaning product sector, there's a lot of change happening. And I think everyone would agree that the customers, and particularly millennials and those generations beyond millennials, they no longer want toxic chemicals, and they're really willing. And I would say, having been to investor conferences, Julie and Susan would agree, they do not want to hold companies that have toxic portfolios. So there's just a lot of things that I think are beyond hopefully taking us into a 5-year trajectory, Jim, versus 25, 20 years. And I think both the consumer demand, you know, big, you know, markets like the European Union moving, states here moving, those are all sort of coming together and really pushing things. And I think you have to ask the question about what is the cost of not taking action. I mean, look at, you know, the SIG water bottle crisis with BPA. They went bankrupt. Lumber liquidator, you know, had formaldehyde they knew about in their flooring, and the CEO resigned over it, and the stock price, you know, dropped significantly, you know, investors bearing that cost. And now we have the perfluorinated crisis. And that to me is hopefully going to be, I would say, the chemical issue that puts us over the edge, and that we no longer are doing the end of the pipe, you know, responding to crises, and we're intentionally designing chemicals that are safer for human health and the environment. And those are actually rewarded in the marketplace. They're safer, cheaper, affordable, and have higher value for investors.
Thanks, Alex. So first I wanted to ask a question of anyone on the panel related to the data related to millennial behavior. I mean, as a casual empiricist sort of watching this generation, which is generation or so removed from me, they certainly seem to be far more focused on issues of chemical safety than my generation was. What does the data show about their behavior? And is that, you know, someone who's analyzing, you know, who's going to be buying what in the future, trying to go where the puck's going to be? Just how strong is that data? How confident are you in that data? Is the trend you'd say is this isn't going to change anytime soon?
So every survey that I'm aware of that asks millennials about what their values are, what they want to invest in, or both, shows that they are interested in sustainability. This is their planet. They're going to have more years left on it than we are, so it matters more to them. I would argue, as a boomer, you know, that participating in the first Earth Day March, you know, we all did too, but, you know, and we got some things done, but not enough. And so the millennials feel like they have inherited a world that is on a collision course with catastrophe. So they do want a more sustainable future. They want companies to play a role in that. They are much more likely to want to work for a company whose culture and values they believe in. Right now, and I think that's part of what's driving the real surge in ESG funds and sustainability funds. There's been, you know, record inflows over the past 2 years. And one thing we have seen, both in 2008 and now this year, is that sustainability funds do outperform during shocks, downward shocks. So they performed in the Great Recession, outperformed, and they've outperformed during COVID, especially in March and April when things were truly awful on the stock market. So we see better downside protection from firms that take more decisions based on sustainability, as well as financial performance. Right now, I mean, I think that impact has yet to be really felt in this industry. I mean, millennials right now don't have any money, you know, speaking for, you know, overstating the case. There are some that have quite a bit, but not many. And most of them, you know, have not yet gotten to the point in their lives where they have significant investment funds to allocate. So we'll see what happens in the future. But right now, if you judge by their sentiment and their wishes in all the surveys, it looks as though that's going to drive a lot of sustainability in investing.
I would add that consumers in
Go
general,
ahead.
they're willing to pay a premium for products that are perceived to be better for you, either your food or lotions or something you're going to put on your body. I mean, there was a Bernstein, a Wall Street firm called Bernstein, that put out a report soon after Croda built this biofeed stock plant, you know, that goes into surfactants. So they can sell these bio-generated surfactants to the personal care products companies out there that are selling the natural products and getting certifications for non-petroleum based products, better for you products. And that's Bernstein pegged that as a 10% premium that consumers are willing to spend. And that's really playing into the return on invested capital for companies. So I think there's a real, you know, there's the social case and there's the business case that as consumers generally want to pay up for these products. And if we see the changing throughout the supply chain, this is a space that's not filled up yet. I mean, it's a market that's just needs more players to move into.
That's where the puck is going, I hear.
Exactly.
I have some questions now from our audience. Is it a more effective way to put pressure on the system through strategic investing by investing in the chemical user or the chemical industry, or both? I assume the user being the customer.
So
Product.
I don't think there's a single answer to that. I think that both are effective mechanisms. They're back 2 decades ago, and I'm dating myself, but you know, I got my doctorate when there were people hunting mammoths, so I've been around a while. It was hard to put pressure on the manufacturers of things and have them pay attention. My example comes from forest products. So there was a lot of activism devoted to the forest products companies not to harvest old growth timber. Wasn't generally very effective. When pressure was put on Staples, which was the major consumer of the paper that they were making, then suddenly the needle moved. And so consumer perception can come into things and place some pressure on, you know, the manufacturers that are farther up in the value chain in ways that didn't work when you sort of went directly to them. That was then. I think most companies have absorbed that lesson now. Like after, you know, the Home Depot finally said, okay, fine, we won't harvest any or sell any old growth timber anymore. Lowe's capitulated in approximately 10 seconds. I mean, it's not like companies don't watch what's happening with their competitors and their peer groups. So, you know, when something works, you'll often see a kind of a halo effect or a domino effect happen. That said, I don't think I would say one or the other is always better. I think you just choose whatever route works best in that particular case.
Sort of interesting follow-up that's related, and which is about how the question is, how can strategic investing more effectively address incumbency challenges of new chemicals development? So incumbency challenge being that you've got something that's widely used, is incredibly cheap, and just it's hard to get someone to invest in the alternative because they've got so much of the market share, and it's going to be hard to compete with it.
Well, if I could again use an analogy, 10, 15 years ago, we would have said the same thing about coal in the energy mix in the US.
Mm-hmm.
There are tipping points, when more and more customers want safer products that, a lot of times you are willing. We would have said the same thing actually about renewable energy as well, right? Solar and wind, they weren't competitive, they were intermittent, you had to store it, all kinds of reasons not to use it. It is, solar is now, according to the International Energy Agency, the cheapest form of electricity ever. So plowing money into R&D, into, paying attention to consumer sentiment, you don't often see the results in a sort of linear fashion. It's often a very non-linear sigmoid curve of adoption we're all really familiar with. But it can happen if there's enough pressure. Just because something's widely used and cheap doesn't make it invulnerable.
Yeah, I mean, I would just add to that and say you had to have, so for a good portion of the last 10 to 15 years, we put a lot more emphasis into the buyers, the customers, the consumer-facing companies. They faced a lot more risk and exposure and had a lot more incentive to move towards safer chemicals. But even that was incredibly hard to get out of those chemicals, those solvents, those materials that have worked forever. And I think what is really interesting right now is we have Vizient, which is I think the second largest general purchasing organization in the country for the healthcare sector, as a signatory on the Chemical Footprint Project. And so now they're starting to put the score of the chemical footprint. You have to disclose your score in their environmentally preferred purchasing agreement. So you're aggregating a huge amount of the healthcare sector towards, preferring these companies that are getting out of these materials. And I think that, is a really huge step forward. Same with electronics. You have the Clean Electronics Production Network. You have Hewlett Packard and Apple and others working together to get out of some of these solvents so that they can really aggregate their purchasing power to make this bigger transition. And I see those as some of the most, powerful mechanisms to hopefully supporting a lot of the, people in the Green Chemistry and Commerce Council who are, at that R&D phase of the chemical industry that, sort of been in the back corner office for a long time. We want to see that scaled.
Got another question from our audience. Is there increasing availability of market research for safer chemicals, chemistry, like Nielsen for consumers or other research for industrial and institutional markets?
Make this really short, sorry, if I can get off of mute. 10 years ago, it was really rare to see financial research that was devoted to anything green. It was like, oh, that's for bunny huggers, and we all know that you're going to sacrifice returns if you do that. And that worm has turned. I mean, the investment, at least on the research side of the aisle, investment has really crossed the Rubicon on sustainability. So you've got all the major sort of sell-side research producers, Goldman Sachs, Bank of America, Citigroup, Morgan Stanley, JP Morgan, HSBC, Credit Suisse, all of them are producing sustainably themed research pieces every day. So yeah, there's a lot more information available.
I would add was that's why Trillium looks to the Chemical Footprint Project as the subject expert, because we can't understand all these chemicals on all the authoritative lists. So the CFP, companies that respond to that, understand these lists, are talking to their suppliers about these chemicals, and that is a sure signal that there's some management oversight there. There's some understanding of risk. And I mean, I think that just goes a long way in helping us as investors understand they're staying abreast of changes in the marketplace and what's going on around the world.
I'm gonna take it back and ask a question that I have. And it's actually not a question. I'm hoping that between Susan, you and Allie, you can you can tell the story of your work with TJX and their shareholders. And I'm gonna really leave the whole storytelling to you. One of the things I find when you start talking about something where you just don't have the right facility with the language, I'm sure I would butcher exactly what happened in that. But the work you did with to convince TJX, which is the owner of TJ Maxx, to embrace a more forward-looking chemical safety policy.
All right, maybe I'll start, and Allie, please jump in with anything that might need clarification. But as I said earlier, so my job is to engage companies. So what do I mean by engage? There are many tools in that toolbox. There's writing a letter, getting a whole bunch of investors together and sending a company a dozen questions. Tell us more about your chemical safety policy. The letter might lead to a conversation. We get some more information. If that doesn't work, we can file here in the United States and in Europe, in the UK, also something called a shareholder proposal. So this allows an investor, and for the next year, if an investor owns $2,000 worth of a stock, we can write a 500-word proposal. It's a request. It's non-binding, but it's a request to provide more information. And there's all kinds of rules set up by the SEC on what exactly you can ask. It can't look like too much of an ordinary business ask. It can't be something that they've already disclosed. So there's all kinds of rules that I won't go into around that specific request. So this is our right. I mean, as a shareholder, you have this right, and we think responsibility to understand how a company is performing, and if we can't get an adequate or a satisfactory answer, we quite often will file a shareholder proposal, giving all shareholders an opportunity to weigh in on the issue and vote at the annual meeting. So the story with TJX is it's a company that we own. We like it. It passed our ESG positive criteria. They've implemented a number of environmental initiatives of reducing, they have a public carbon reduction goal. They've made significant improvements in transportation and logistics efficiency. In 2019, they passed their GSG reduction goal that was pegged to revenues, and now they're moving toward a science-based target. So they really have some programs in place that are pretty impressive. But as we were looking at this company more closely 2 years ago, there were three factors that jumped out at us and where we thought that they were falling behind. And this was on chemical safety and chemicals management. There was no clear policy other than a very compliance-based approach through their vendor code of conduct. We also noticed in our data service provider, MSCI, that it was actually marked down on the chemical safety pillar. And that was because they had limited evidence of efforts to minimize potential harm from chemical substances of concern. And they pegged 100% of their revenues coming from products exposed to chemical restrictions or chemicals of concern. So we took that information as well as some of the information that NGOs had been gathering about this company. We often work with local or national NGOs that are experts on these issues. And through that work, we learned that they had reached out to TJX and in fact sent a letter to TJX in 2018 citing a GC3 report highlighting the business case for chemicals management. So I was just reading that letter the other day and realized GC3 was noted right in this letter. So to their credit, TJX met with the NGOs, and I was able to attend that meeting with Clean Water Action, which is based in Boston, and also Clean Production Action was at the meeting, and we had a good discussion of what they were currently doing. but we left a little unsatisfied that there was a clear path forward. The issue with shareholder proposals, going back to that for a moment, is you have a window of opportunity to file it. And because we didn't have enough time to have another dialogue or a deeper dive, we filed this proposal as a placeholder to make sure we had meaningful dialogue in the following year, which was 2020. Yes, okay, so we filed in 2019. So we filed a shareholder proposal. What did we ask the company to do? We wanted it to provide a report for us, omitting any proprietary information or confidential data, describing its strategy to manage and reduce its exposure and use of hazardous chemicals, really if and how it could reduce its chemical footprint. So it was the first proposal on a company's ballot that actually used the word chemical footprint. And we thought that this would begin to get the company to move a little faster on developing a policy. We had one more conversation with the company. We weren't able to reach an agreement, so we said, let's leave it to the shareholders to vote. They did so in May, and it garnered a 44% vote. Okay, that's not a majority, but for a first-time proposal on a issue that hadn't been put on a ballot before, we were really pleased with this vote. And it turns out we got support from some major investors out there, including Fidelity. They voted for this proposal. And it, I think, really raised the issue with investors and basically sent an important signal that companies want more information. They want, particularly retailers, to assess the chemical risks in their supply chain. And with TJX, I must say that one of the reasons that they resisted our proposal was they felt that because they are a purchaser of overstocked product, that they don't have real insight and visibility to their supply chain the way a manufacturer of private label assortment would. But as TJX gets more profitable and grows, they are beginning to have a larger impact on their supply chain. They are developing some private label capacity. So that would be a real easy place to start, is with that private brand owned, exclusively made, it's another term, assortment. So we thought at least that they could start there. And I think that too resonated with investors, is, get on the bicycle, start this process, do it with your private label. We also got support from a influential proxy advisory firm. So that helped our proposal get a double-digit support. I will say that we are investors in this stock. We want them to do well. So we're continuing the conversation and hopeful that this will lead to some more meaningful policies and practices in their supply chain, and that this will become a competitive advantage. We think it can be. We think if they want to have customers come in and have a healthy experience, they want their employees to know that we want them to tell their employees that this is an important issue. I think it's in the culture of the company. I think they just need to prioritize it, and we hope they will.
Congratulations, Allie. Did you want to add any?
That was a great overview, and Susan really, led this effort. And I just wanted to say two things. One is I'm going to steal from Susan on something that she had said about compliance being the floor of investor expectations. And I think this is where we see the great divide in the retail sector. Between sort of retailers really focused on compliance only strategies versus retailers like we've mentioned, Walmart and Target, really going beyond compliance, looking at the science, looking at emerging consumer concerns, looking at a broader set of factors, because we know that the regulatory system just, it can't keep up with the marketplace. It hasn't kept up with the marketplace. And so that's not the strategy to really protect assets, is to just be in compliance. And I just think that's really a dated strategy. And I also think the other piece is that we didn't have a really well-organized way for investors to engage on these issues with chemical safety. And I think that, you know, is really changed in terms of, you can report on a chemical footprint as a metric that represents a much broader set of, I would say, practices within a company. So if you can't get to a chemical footprint metric that is defensible unless you have a very well-established chemical management program, which starts with a chemical policy, and that's, you know, really what we've tried to do to simplify, you know, what it means to get to a number that's, you know, really meaningful to companies. So I just, you know, for us to see sort of investors respond positively to this gave us a lot of confidence that we're moving in a direction that we can help investors measure this, and that companies really should understand they have an expectation to disclose these numbers in meaningful ways. Investors then can weigh their own sort of tolerance on risk or value.
Looks like Susan may have dropped off there. Hopefully she can get back in. Oh, there we go. The questions just keep flying in from our audience. Let me go back to their question. So, and this is for any of you who have any insights. Have you come across companies that have a policy and implement a benign by design approach when introducing new or alternative chemistries? So really forward leaning, I would say that.
I'm not the person who does the, there are 4 other people at our firm that do the ESG analysis of most companies. So in general, I'm not going to be looking at specific companies. I think one of the closest examples I've seen is actually a private company. It's not publicly traded, although it does, I believe, have publicly traded debt, and that's SC Johnson. Sorry. I live in Colorado, and there's a lot of smoke in the air right now, so I'm sorry, I just turned into a frog. But yeah, there may, you know, I would imagine that there are others, but you know, I'd be happy to provide examples later if you want to email it out to the participants.
Thanks.
I would say just on that, there are companies, so like 7th Generation, which is, a subsidiary of Unilever, I think, is really the only company that scored, 99 on the chemical footprint project. And they're starting to look at regenerative products. What is a healthy product? What's a product that actually sustains life and uses materials that sustain life, and thinking about that from the manufacturing to sort of the product use and end of life. So, they are at the very, very front end, but I did just want to touch base on like Susan's example of DSM. I was in a webinar with them recently where they characterized their work around this is SDG 3, which is good health and well-being. And I think companies that are setting sort of a North Star for healthier, better materials and chemicals versus trying to control the risk or trying to reduce exposure, they're actually trying to make it inherently safer. They're the ones, that I think are really going to be in the beneficial sort of competitive advantage, with big customers and consumers that want, these products.
Thanks. Next question is, how can startups with validated technologies attract investors to fund scale up of innovative new chemicals?
The whole venture angel financing realm is something that we don't do. I don't know if you do, Susan. But often what I have noticed, I've been in sort of Rocky's Venture Club and a few other places where we have startups that are, and I get at least 2 offers in LinkedIn to, to invest in companies with insanely great sustainability ideas, which we can't do. We can buy them once they're publicly traded or once their debt is publicly traded. So for startups, I think there is a developing, nascent, growing consciousness among venture and angel investors in sustainability. I can't necessarily prove that. I've seen a few papers written about it. I don't think it's rampant as yet. And most of the time when we see companies do IPOs, which is their initial public offering when they are listed on a public market, most of them have no clue about sustainability. And so they kind of need to get the education that the big publicly traded companies get now. So to the extent that startups are able to incorporate sustainability early, you will be rewarded for it when you IPO.
Yeah, and the B Corp movement I would mention as one that would be a valuable resource for any startup that you described, Jim.
Susan, for our participants, could you describe what a B Corp is, the structure of such a company?
Sure, it's actually a legal structure. You probably heard a lot about shareholder primacy in the last few months because we came upon the 50th anniversary of an influential economist by the name of Milton Friedman and his essay. And Julie, you could probably speak to this better than I can, but he really divorced, profitability from social and environmental good in the investment arena. But the B Corp is really looking at all stakeholders, shareholders, communities, employees, workers, and the benefits of all of those in the operation of your business. And it's a legal structure, as I mentioned. Trillium is a B Corp. There's an assessment process that you have to go through to maintain the certification. But it's a large network, a growing network. They're trying to get more publicly traded companies involved. Danone is committed to transform its divisions one by one into the B Corp format. But it's a valuable, again, toolbox of how to incorporate stakeholder capitalism.
It could also be useful to, and some of our listeners may be aware of this, but the distinction of what an investment firm along the lines of the two you work for invest in, sounds like publicly traded goods, versus who invests in a company that's just getting started, that doesn't have there is no publicly traded stock, and the difference between the firms that would invest in a startup versus a firm that would invest in a publicly traded company.
So I referred earlier to angel and venture investors. Usually you start with angel capital. Most entrepreneurs start with their own capital if they have any. And then they'll get their family and their friends to put in. And then sometimes they will next go to the angel network. And angel networks are not necessarily formalized things, but they often consist of people who have made money, significant amounts of money, and that want to bring new businesses online. So a lot of formerly successful entrepreneurs become angel investors. Once you graduate from the angel financing round, which is, companies may have, 2, 3, 10, 20 angel investors in them. Once your capital needs are greater than that, you might go to then venture capital or private equity. And these are firms that specialize in investing in not publicly traded companies. There's a huge range of what venture capitalists do or private equity firms do. Some people refer to them as vulture capitalists because they basically are helicopter parents and they're a pain in the ass. Sorry, a pain in the butt. Other times they can play a really positive role in bringing companies growing them to the point where they are able to there's usually an exit plan. So every entrepreneur usually has an exit plan at some point. And that exit plan may be being sold to someone. So your exit plan may be, I want to get acquired by Unilever or Danone or something like that. The exit plan might also be to become publicly traded. And a good venture capitalist will help you along the road to achieving your exit.
Thanks. I think that, so I know I was getting confused when I first started wandering to this field and would be asking the investment company about basically how do you help a startup, and like, well, go talk to somebody else versus an investment firm that is buying publicly traded companies. Thanks. Another question from our audience: how does the sustainable investment community offset the impact of the activist investor, in quotes, community that buys companies for quick profits, when investment in green chemistry is a long-term investment where a new green solution doesn't make lots of profit for a chemical manufacturer in the short term?
There are a whole lot of options when activist investors target firms. Often what they will do is what's called short them. So they will, a short is you basically buy a company with the expectation that the price will go down. And then when it does go down, then you handle the other half of the trade. So you buy a company you don't own, basically, with a promise to sell it back at a certain price. And if you are right, you can make a lot of money that way. Shorts there's very little that sustainable investors can do to counteract that. Once those firms are targeted, there's, you can, if you still think it's a good investment, you can keep your shares, you can dialogue with the company. But, if there's a lot of activism, a lot of investor activists, and they target a company, there is very little that we can do to offset that, except if, in the rare situation where the activist actually puts up either its own board slate or runs certain members for the board, you might be able to vote against them.
Okay. Are you, as investors, finding companies more or less willing than they used to be to discuss a chemical's risks without need for a resolution? Not sure without need for a resolution, but more or less willing to talk about a chemical's risks?
I am always happy to talk to companies without the need for a resolution. Usually the only time we file resolutions is when the company does not respond to requests for dialogue.
So, go ahead, Susan.
Yeah, I would say it's improved over the years, but usually, yes, they usually bring a corporate counsel person on the call if we're filing a shareholder proposal, or they think we will be.
So a number of times over the course of the session, I heard reference to a company's chemicals policy, and we have seen in the last, I'd say, 7 years, starting with Walmart, the retailer sector embrace chemicals policies pretty ambitious. I think now over 40 retailers of significant size have a chemicals policy. Is that sort of a necessary condition as you're doing, an ESG chemicals evaluation of a company, not just a retailer, but any company? And how much weight do you give the existence of a chemicals policy versus the lack of existence versus the execution on a chemicals policy?
Yeah, you just broke the code, Jim. So having a policy is better than not having a policy, but we're not just looking at whether a company has a policy, we're also looking at whether it's working. So if a company keeps getting into controversies or keeps having, screw ups where they discover some tainted thing, or, that there really is something in a product that's not supposed to be there, then, the only judgment you can make is that you really need to work on your policy and implementing it better.
And the policy to us indicates that there's been some high-level discussions, there's been some deliberations about governance oversight of this issue, that it's going to be enterprise-wide, that it's not, not a matter of just chemical by chemical. So that's why I think it's critical to understand, that it exists, it's public-facing. There are key implementation mechanisms. There's, outcome and impact measures as well, and review. It's like any human rights policy or a diversity and inclusion policy. It has to be robust. It has to be enterprise-wide, and they have to be able to publicly disclose it and review it.
I would just, add to that, the Chemical Footprint Project spends quite a bit of time on policy, and what is the scope of the policy, since they're not all created equal. As Susan was just saying, some policies can be fairly ineffective, or their scope is very, very limited. And so a policy signals intention, and it also it can sort of integrate in with the corporate governance, piece of this. And the Walmart policy, which is much broader than just this, but they set an actual footprint reduction goal, like 10% by 2022 in their consumables division. Like, that is such a, that to us is best practice. We'd like to see more retailers within their policies set some of those measurable goals and targets, because then it infiltrates into other quantitative metrics investors can use to, look at their risk and value on an annual basis.
Yeah, there's several different parameters of intention. One is a policy. We believe in diversity, Black Lives Matter. And then there's the procedure to implement it, which is a lot scarcer than the actual policy or the statement in support of something. So when you're able to see a procedure, here's how we audit our supply chain, and here's how often we do it, and it is in accordance with ISO, whatever it is, standard. And then there is performance, which is how are you doing against that? And then there's the goal, the target, and quantitative targets are obviously much preferred, and absolute targets are preferred over relative ones or revenue-based ones.
Well, I have run out of my questions, but I'm gonna call an audible here. And if there are any questions that the panelists would like to ask each other, and while you're thinking about that, if our audience has any last question that they would like to ask any of our panelists, now would be the time. Give folks a second, since we have a few minutes left. See if any more questions come rolling in. But one of the most encouraging things for me, we all live in a little bit of our own bubbles, and I'm certainly in my bubble, however one wants to characterize it. But I have part of being in that little bubble has been, I really feel like that the consumers, this is where they want to go, and this is where they're going to go. And if you want to sort of take advantage of that, whether you're a company or an investor, you need to recognize that and get there with them, or get there in front of them if you're an investor. And it's kind of validating to hear that the investment community thinks similarly, that this green is the way the consumer's going, and time to get on the train.
Well, speaking of green, I would go back to the sort of bio-based systems and say the thing that makes things green is sunshine, and that is the best disinfectant, right? So if you want people to know where you are going, tell them. Because if you're not transparent about it, if you don't say so, they have no reason to think that you're managing these risks or taking advantage of the greener opportunities.
And we all know how social media has changed so much of our lives, and it's really changed the investor landscape too. So that's why, paying attention to consumer surveys, NGOs that are really tapped into consumers, who create scorecards that give us valuable information on a company's performance. And Mind the Store, which is part of the Investor Environmental Health Network, provides some valuable information to us for the retailers on this sector. We also work on agrochemicals. We didn't talk about that here, but that's another emerging area of concern, both for consumers and for investors, looking at pesticide risk across all, food and home improvement retailer sectors, companies. So I think as more information gets out there, this issue will become even a more critical component of investment analysis.
So Jim, I'm going to read a couple questions that came in
great.
here.
Thanks.
So one is, has the investment community thought about science-based targets for chemicals like those for climate and biodiversity? What would those look like?
Science-based targets are tough. The reason that we have them for climate is because we have the Paris Agreement, And we know from the climate scientists and the CMIP 5 and 6 modeling that the concentration, what the correlation is between the average temperature on Earth and the concentration of greenhouse gases in the atmosphere. We know in order to stay below 2 degrees, or at least the best science right now tells us we have to get to net zero emissions by 2050. We don't have anything like that for any chemical, and we certainly don't have that for biodiversity. I mean, we know for biodiversity in general that we wish to avoid the million species that the UN says are going extinct this century, but how to establish, quantitative targets for that and how to establish accountability over it, since most companies don't control the entire habitat of any species and there are always other actors involved. It's tougher. So no, we don't at this point have anything that you would regard as a science-based target. There are, when we have exposure limits from like the public health authorities or EPA or something that says, this is the level beyond which exposure is unsafe. Those are the levels that we expect companies to conform to. But that's as much as I can think of.
So perhaps another quick one to tuck in here, compare and contrast bottom-up consumer demands versus B2B company demands as drivers for chemical policy change.
I've seen an increasingly active B2B engagement between companies. So it used to be that you would, well, I'll just take another analogy. Back in the 2000s, we were asking apparel companies to have policies regarding child labor and slave labor and forced labor and so forth. And that was, up and down, up there, or in their value chain, uphill. Very few companies had those. We're seeing more and more, you heard Allie and Susan talk about TJX and Walmart, that companies are increasingly the sort of end producer, the one that faces the consumer, insisting that their value chain be more sustainable because they're going to get tarred with that brush if, even though those are other companies. We saw that in particular after the Rana Plaza factory collapse in Bangladesh, where there was this global movement for safety in apparel supply chains, or I won't go into depth on that, but basically the idea was there are no clothes that are beautiful enough to die for. And we're seeing that increasingly from, the retailers upstream. It's not universal by any means.
Jim, you want to close us out?
All right. Well, I really want to thank our panelists. This was a very interesting session, certainly for me, and I'm sure for many of our members who were able to join us. And I'm sure more will see it because we have it taped, and we'll be able to send it around to members who weren't able to join us during this hour and a half. So really, thank you, Julie and Allie and Susan. Great session. Hope we have an opportunity to work together going forward.
Thank you.
Me too. Thank you.
Have a great day.
Thank you to our terrific speakers and to everyone for joining us today. We look forward to seeing you on Thursday for our last session of this GC3 virtual roundtable. So on Thursday, we will share perspectives from the C-suite. The discussion will explore lessons learned from the COVID-19 crisis about quickly adapting to new market conditions, shifting nimbly to meet demands, and commercializing new products. Some of the learnings can be applied to commercializing new green or sustainable chemistry alternatives, and we hope you will join us. Thank you.